Hi everyone, and welcome to another quick take video. Today we are looking at Coles Group Limited. Now for those who live in Australia, you would know what Coles is about. But for those who don't, it's basically a grocery chain in Australia, one of the big two. The other one is Woolworth. Or if you live in New Zealand, I think they're called Safeway, or maybe in another state. In Australia, it's called Safeway. Anyways, Coles is one of the big two grocery shopping supermarket. There are also Aldi's now, and that's a German brand. And you also have IGA, so that's an independent grocer association. Anyways, Coles is well known. If you say Coles, people would know what it is. It used to be owned by Wesfarmers, but now they kind of split into two, so they have their own share. So employees of Wesfarmers used before the split, they would get Wesfarmers shares. So employees of Coles would get Wesfarmers shares, and I believe after they split up, they also get Coles shares, so I think they get two. Otherwise, they just get converted over to Coles shares. Anyways, that aside, if you already got it, it's fantastic. You leave a comment to let me know exactly what happened to your shares. But beside that, I don't really know much about the financial situation of it, so that's what we're here for. All right, let's have a look at the ratios. Today is the 28th of January, and the market was red. And we'll talk about that in a second. PE ratio looks good, 25. Industry 18, so it's higher than normal. But it is recently split, so relatively recent. But it is still a very big chain, and it's fine. 25 is within the ballpark for what's considered being cheap. Now, does it have quick ratio? So it doesn't have a lot of cash, and dividend yield 3.11%. Okay, that's again better than putting your money in a saving account. So you gotta think of these opportunity costs and the risk, and you gotta weigh up to see what works for you, what doesn't. Let's have a look at the annual cash flow. So let me have a look. So it's gone up, and I expect it to in 2020. With a lot of things being shut down in Australia, like small businesses, Coles and Woolworth are considered essential services, or any of the grocer considered essential services. So they were allowed to keep opening, and people were hoarding stuff. And I'm sure you guys seen videos surface on YouTube of people fighting over toilet papers. I mean, there's a virus coming, and the thing that we fight over is toilet paper. Anyways, crazy, right? Australia, welcome down under. All right, investing activities. Investing activities looks good. So it's investing in stuff. That's always a good sign. Financing is negative, so it's paying back debt. Again, another great sign. Net change in cash isn't great, but you got to consider the whole perspective. It's paying out dividends. It's paying a lot of dividends for pandemic time, I got to say. So let's consider that. Paying back debt, it's always good. Probably during this time when interest rate is so low, probably can scale back on the debt paying, or at least probably can borrow a little bit more money. So I guess this reverse of what I've been saying, but about paying back debt. I mean, paying back debt is always a good thing, but you got to pick when to pay back debt and when to borrow more money, right? If the interest rate is low, you probably want to borrow the money and then do a little bit more investment, preparing for the future, investing in new technology and all of that. So anyways, looking good. It's not looking bad, let's say that, but I think it's looking good. I always like Coles more than Woolworth. I mean, depending on what I go to Coles more. There's certain things I like in Coles, certain things I like in Woolworth, and being in like the essential service and industry, and if you think about it, during a market downturn, people still need to eat. right? And it's called consumer staples for a reason. It's because people still need to eat, people still need to buy stuff. Probably, stuff, luxury stuff that they don't need, and maybe they'll cut back on it. But like essential stuff like food, like fruits, vegetables, meat, all of that, people are still gonna buy it. So there's still like a level of security for the company in terms of income. People may scale back on purchasing stuff, and they can always scale back on purchasing stuff, but I've obviously got to get rid of their inventory first. So let's have a look at the balance sheet and really have a look at the inventory. Total inventory's gone up, and there could be a reason for this expanding. They're stockpiling. Stockpiling is a scary thing because that's basically cash that is trapped. And consider the industry they're in. They're perishable goods, right? They can't stock up too many lettuces, and you can't stock up too many tomatoes because it's gonna perish. So you need to be able to get rid of their inventory really quick. And you want to see companies with kind of lower inventory, or at least getting rid of the turnaround time of those inventory. Cash is 992, and we got current liabilities is huge. Like, no wonder it's only 0.2. A quick ratio is only 0.2. So there's certain things here that does worry me. So let's see what's happening. So total liabilities $15 billion, total asset 18. So at least it's over. But again, we already talked about this. Cash is king. You can't pay back your creditors $1 million worth of tomatoes. It's just, then what are they going to do with tomatoes? They can't on-sell it, and if they on-sell it, they can't do much with it. So they probably just, it's like, well, no, we want cash, right? All right, income statement. Let's have a look at that and jump over to the chart. All right, income. Cool. Revenue. Revenue's gone down a little bit. But it's still considered okay. Like it's going down for the last 3 years. I'm not too worried, especially in 2020. What you want to do is look at the competitors. Maybe some of the independent grocers won't have any are not publicly listed, so you can't actually see the financial. But basically, you want to go say like, right, what's the reason for the drop in revenue? Is it because people are going to the competitors, or is it people are just spending less in general, right? So you can weigh that up. You got other competitors' financial detail. If Coles goes down and Woolworths goes up, then it's kind of, well, maybe people are moving over to Woolworth. But if both of them are going down, then you kind of have to look at it. It's like, well, maybe people are just spending less because of hard times. So you want to look at those things in context. All right, jump to net income. Net income's gone down a lot. So scary, isn't it? So this. Look, research and development. I don't think I'm expecting Coles and Woolworths to do any research and development. So it's one of the things like, yeah, whatever. You don't do research development, that's fine. I'm just trying to think like genetically modified food, possibly, or maybe they could invest in new ways to keep vegetable fresh, right? So that could be a recent development, but I doubt it. It's a retailer. I mean, it's not to say retailers can't spend money in research and development. Amazon does a whole bunch of research and development. I'm not too worried about this part. And yeah, look, it's looking okay. I'm just worried about the net income. So probably what I want to do after the quick tech video is just look at the competitors, see what's on the market, see what's growing, see what's stealing its market shares. Anyways, let's jump over to the chart. Yeah, look at that. Not looking good, even though the price is rising. So it's kind of like there's this divergent in like net income and the share price. What is justifying this share price? Is it reaching? Is it going up to the price that it's supposed to be? And now it's the market kind of say, well, the income is dropping. Should I, is it really worth, $18? And the answer is we need to do more research. But in terms of looking at the actual chart, it's a steady growth. I think it's, even though it's just recently listed, the company's been around for a while. And I think it's already past its rapid growing phase. Could be very at the very end of it and toward the top phase. And if they don't do something about it soon, I think they're going to be in the decline because there's new players in town, newbies, but, they're catching attention. Audis, always people talk about Audis and the unique offerings they have in the aisles, and IGA and all of that. So I think what it is, it's safe-ish investment. If in the market downturn, I think it's a safe-ish investment, especially if like whatever happened in the pandemic here. Let's say, was that May? Here it is. Bam! This is when we have like the lockdown and then gone up, because like the only thing that really, like the only few businesses that are making money is Coles, Woolworth, and other essential services. So it was a nice environment for them. But after the earning comes out, it took a dip, and I think it's gonna plateau. So in terms of the plan going forward, I don't think I'm gonna buy Coles or anytime soon, or any stock soon actually. And here's where we get to that part I was talking about. The markets was being read today. So there's a general fear in the market that the whole market is overvalued, and people are kind of just holding on to cash now. So selling what they can, holding on to cash. So there's this fear. And when I trade the VIX, which is the volatility index, the S&P 500 volatility index, and then I've been making a little bit of money there. And then but the thing is that the main thing about that is to basically you look at the VIX, and then there's a lot of volatility. So there's a lot of fear in the market. But this one applies to the S&P 500, so it may not reflect the Australians ASX very well. So look, actually very convenient. Look at that, all red. Bam, look at that, all red. This one, look, it's 0.5%. Bam, all red. Look at that. Oh, these ones are funny. Look them up. GameStop, AMC, Cost Industry, and Express. Very, very. Is that 6 point? I have a look at it later. Anyway, so the plan is probably review. Not very interested in this one. And that's pretty much it. Thank you so much for listening, you guys. If you like what you watched, please leave a comment, like, subscribe, all that good stuff. Share the video to people who also do investing, trading. Comment any thoughts or any arguments against what I've said. I welcome all of it. The more we kind of converse, the better traders will become, because we get difference of opinion. But beside that, have a great day trading, investing, and best of luck to all of you. Cheers.